Hey guys, good morning. It's Sunday, and I thought I would give you a little bit more background of how I came up with the JATS PT indicator. I was reading this PDF booklet that's available on the internet from J. Wells Wilder, New Concepts in Technical Trading, and I never really got past the first page. There is an introduction and what you'll get from this book, and then the first page was on these parameter ranges, and I dove in head first to these concepts. Let me get back up here. Sorry, dove head first into these concepts of this bell curve, and it dawned on me from my research of this that you could use these statistical probability distributions to trade. And so I got an Excel spreadsheet. I started doing my own distribution models and slicing time up monthly, quarterly, daily. Well, I was doing a 15-minute range at the time and trading to my 1, 2, and 3 on that lower time frame. And I said, this is really good. It hits my levels consistently, and then I realized that, it is fractal. Not only the 15-minute range, but the 60-minute range, the 1 hour initial balance range, the daily range, the Globex range from 1700 to 8:30 in the, after hour session, the RTH session, monthly, bi-monthly, 2 months, 3 months, 12 week. They all have their own distributions and that can be measured. So I spent a lot of time developing the indicator to provide these ranges. Why do I think that the bell curve works? Well, I learned all of this after I built the indicator, interestingly, that the market is basically comprised on these statistical methods of this probability distribution curve. You can figure this out when you watch Citadel's High Speed Trading in Action video available on the internet. CNN produced this excellent little docu series or short video about how Citadel creates their high frequency trading methodology based pretty much on the bell curve and statistics. That's what it is. And so we've got tapped into the market structure, which is basically very simple. You have a Gaussian distribution, a probability distribution, and the this will allow you to quantify the data. Like I said, across time series, monthly, quarterly, weekly, daily, Globex, 1 hour IB, etc., etc. 15 minute, 60 minute. Um, and it's the same concept. You have a one standard deviation inside your around your mean. Then you have it's either going to stay inside. If it breaks, where does it go? It goes to the two right there, 1, 2. And that was a fascinating. That's right. I was like, you sign me up, right? If I know where to go from the 1 to the 2. um, so, and then the 2 to the 3 if it breaks. So you've got your 100%, or you can go to your out of the money levels when it breaks the distributions or the tails, whatever you call it. And how do you know if it's going to stay inside or go to the twos or go to the threes? Well, that's based on the volatility in the market and whether the volatility is contracting or expanding. If you've got contracting low volatility, you're going to stay inside that 68%. So you could derive a trading plan around that because you would have something that you could rely on based on current volatility. So if the volatility is low and it's, staying below a certain threshold that you can, visualize, um, you can rely on that information to trade within that range on these time frames. If the volatility is medium, you can increase the distribution and take it out to the twos. If the volatility is high, then the curve flattens and you get to go out even further. So the volatility will be uh, e- expanding so that you can reach those twos, ones, twos, and threes, twos and threes from the one. So that's all said and good. How do you visualize it? Well, my indicator comes in two different sections. I've got one part of it that allows me to put the lines on the chart for the probability distributions, the ones, twos, and threes. This is actually a quarterly distribution, and you can see that, for years, decades, that the market was supported with the liquidity. And so they would come in and buy the ones or twos and whenever it dipped pretty routinely. And then this year, when the Federal Reserve decided to remove the liquidity and start, contracting its balance sheet, um, and the credit's tightening, the market got more volatile and the market started selling off. So we're definitely in a bear market, and we're in a bear market rally inside of the bear market. So we're clearly going down. We're in a period of disinflation, meaning the inflation is still rising, but at a slower pace. Um, so we know not to get too euphoric, even though we have a positive occurrence now, a seasonality for the midterm elections. Got a split Congress, which the market loves. And so that's supportive of the market. And so, put your macro themes to play. But I like looking at the volatility. Am I falling or am I rising? And normally, when you're falling, it means that you're going to be, buying those bottoms and bringing it back up to the ones or to the mean. And if you're rising, normally it means that it's going to start selling off. But these are strange times in a bear market. Sometimes you can get markets falling in low vol, and that's what occurred in February. You had a low vol sell off, but that is sort of outside the norm. Normally, if it is contracting, you're going to get that support in the market and move, flat or inside your ones, trading up and down inside of here, and then reaching for those, upper targets to the one, and then see if the market comes in at that location to sell it. Because if you look at your bell curve, if you're going to be in a bear market, you would I'm trying to find this so I can show you here. You would you don't want to be buying this upper 1 to 2. This is where you want to send it back down. So this selling this upper one to go back down might get you that all the way across, which is, where you can make a lot of money, where, timing the market. But otherwise, if you're expecting the market to stay flat, disinflation, deflation, stagflation, whatever they're going to call it, as we bring our supply chains back to a higher cost, costs aren't going down. It's not going to cost the same for those supply chains. They're coming back from China. Our labor is more expensive and our real estate and everything. So costs might, you know, not decrease. So the market is sort of going to be like flat, I think, for the equities. I don't think it's going to sell off. I think it'll be supported because we're going to be exporting more, supporting that GDP and getting that USMCA back up. But it might be a flat market. So trading inside the ones is probably a good idea to address this, and that would be right in there, right? There's your sweet spot. Now, of course, I've got this volatility indicator normalized at 100, and I can see that when my peaks top out over 100, that's when the market reaches for those, outer targets, reaches for the bleachers, right? That's when you want to really pay attention. You've got high vol and it's expanding. You're going to be expanding out to the range. Um, right now we are normalized. We're below the 100, came right up to it, but it's sort of flattening out. So I would expect to see that this continued pattern of selling the one would, remain in force around 41.55. So I think the market puts about a 10-point variance behind that for their uh, call wall. So definitely take a look at Quickstrike and find where the high volume is for the open interest. Um, so I would be looking at 41.55, 41.50, and we can see the highest volume um, was around 4,000 here, but 41.50 has a good bit. That is a very strong volume level. So we've got 6,500, 96.50, 8,000, 2,000. These are the different strikes. 5,900, 3,218, and 41.70. There's your buffer. So between 41.50 and 41.70, um, if 4100 doesn't take it down, 4100 also has a lot. But you can see that you're getting into your high volume areas um, at these levels. So I would say that there would be a good chance with my thesis um, to come back down. So if I want to bring it down, the easiest conclusion would be that I would see higher vol, right? But I'm kind of, reminiscent of what happened back in February at these ones, and I could see it, flattening out and chopping around flat inside this quarterly level all the way to Christmas in between here, just flattening out. So that would be a pretty good high probability trade. My indicator, you can put the monthly, quarterly. So I've got 3 month and 12 week. I can calculate from the open and the close of the session. So I put both on the chart. And I've got a 200 EMA and SMA. And I've got the volatility PT2 component to this. So I can see if the volatility, where the threshold is, and whether the slope is rising, showing that range expansion, or contracting. Um, so the contracting range staying below the 100 is more conducive for it to come up to its higher um, target zones. Monthly, where you can see that we're sitting right here on the monthly one at 40.30, 40, what is it? 29.30. Yeah, I would say 40.30. And so we could probably anticipate, even before it gets to 40.50, that you're going to start seeing some selling coming in on that monthly one. We are mid-month, a little bit, right in the middle of the month. So that first touch likely will get some resistance, I would think. And on the weekly, you can see that the 40.30 It actually is a little bit higher than that. It go from 40.36 to 40.48. So 40.30 to 40.50 is definitely a sell zone, in my humble opinion. Using my ability to use the standard deviation historical volatility. And again, just pay attention to the volatility, and don't get fooled that you can't go short on low vol or vol decreasing, because you can, like it did in February. Here's the daily chart, and I want to show you this daily Globex. This is a pretty cool distribution. So what I've done is I've put the open and close, differentiated them. The open is in pink for the one. The Globex 1 is in pink. And the Globex 1 for the session close is in white. So you can see the difference between these and how the market responds inside these levels, intraday time frame. And then I put the daily threes on the outside. So it very interesting. 95% of the time, you're going to stay inside this distribution. Uh, the market needs to be consistent, and the banks, the pension funds, the 401ks, they all rely on these distributions remaining constant and tradable. As you can see, the E-mini S&P 500, respects these very well. I have noticed that if the daily three will break, you definitely are looking at your Globex open or close. Whatever the top Globex is for your um, risk should be, because they will use that Globex. So whatever, if it's a daily or a Globex level, use the outside of that one day open and close level as your risk. And that works, like I said, if you just take a look at these day after day after day. If you were selling premium, it's like you get to keep the premium for every single day that you sold this in, except on some days, like Vixpiration, you might get a slip, and here was a slip. So this last candle would have need to have been hedged, because your risk would have been right below that Globex. So you would have wanted to hedge that. So you need a plan, because nothing is 100%. And here is an example of that breakout too. Um, Hedge it by either buying a put and going with it to offset that strangle, or just close the strangle and buy your put and roll the distribution out to the next one. Roll your premium out to the next distribution is what a lot of traders do, and bring in the ones. Roll it, roll it out. Vixpiration, OPEX, those are the one time of the month that you can anticipate a break in the structure. Otherwise, um, it's very um, much a good, strategy to trade is the standard deviation bell curve for that reason. And I've got a chart where I can put them all together, the quarterly, the monthly, and the weekly on the same chart. So these levels will pop out even more for me. I can see that I'm inside this quarterly range and coming right into resistance here at that 40.30 before it reaches the 41.55. So I think that my ability, by being able to draw the bell curve on the chart, is a tremendous edge to anticipating where these turns in the market might occur, I can confirm it with the open interest, looking for your puts and calls. There are other methods. There's a summary report to show where the highest puts are sitting or the highest calls. So you can always be prepared that that's where the futures market likely trades to. Um, so you can see this 4,000 area was the highest option open interest, and also really interesting that there's excuse me one moment, there are far more out of the money puts sold at the moment than there are calls. So that shows you that the market is being supported at the time being. At the time being, this can change instantly, but at this time, the market is being supported. So you can come underneath the hood and find those puts, the strikes that they've got them at, and then design your trade plan around that also. Find out what happens when the market gets to those puts to challenge them. Um, so I like using the standard deviation bell curve on daily, monthly Globex um, data, and I like the ability to go in and sell some premium to collect um, that premium and use it either to place a day trade or to just keep, moving forward with a um, positive, expectancy rate of return. If you use the ES, you would be wanting to use the SPX to get the 1256 um, ability of capturing capital gains versus ordinary income. That still applies. And as you can see here, the market really respects these levels. Friday, we went right up to the daily one and Globex levels. There's the Globex level here too. So let's put some spreads together real quick. Sell some premium. Let's look at a weekly. So I can choose the weekly contract right here. This would be expiring November 18th. I changed my model to the Black Scholes on the settlement. And I look at my strikes. I'll put it at all. And what I'm looking at when I bring this down is the mean is at 4,000. And I can see that I've got this opening range around the mean, 3990 to 4005, and the 4005 just happens to be close to high gamma. High gamma is at 348, which is at 4015. So if that 4000 gets hit, market likely is going to want to hit that high gamma because it just, is attracted to it like a moth to a flame. 4015. And see if that is the place where the market turns back around, somewhere, since we're already sort of a little bit past that weekly. It might run, up a little bit higher to that 4050, 4060. Um, but right here, this red green combination for the weekly shows you that the market will be flipping from at the money. So you're at the money to in the money. And in the money, higher would mean that they would be buying calls higher. So between 40.50 and 40.60 and 40.65, if it goes higher from 40.65, they're going to be buying calls up into this first and second standard deviation break, right? This is implied volatility and or their standard deltas. They like to trade that 10 delta, and that 10 delta sitting right here with this red green switch. So 41.35. And so you would be looking to see if that would be the area that you might see some sell interest come in to push it back down since we're in a bear market. So either 41.35 or 40.55. And 40.50 is right at the ones for the weekly. So that first touch of the weekly contract um, might be a good place to try to sell a call, 40.50. And if you had to take that off and roll it out, you would probably want to move your contract to 41.50. And that would be behind the second standard deviation of the weekly. And if the market is really exuberant in this, land of disinflation, deflation, stagflation, inflation, we could start talking about moving it out even further. But, I'm, kind of dubious that that would happen. So I'd be looking for this as a sell zone next week. So might want to try selling a call at the first level of 40.50. And where would we want to put our put? We'd want to put it below this white line. So that would be at 36.50. Always offset a little bit. So 36.50. So let's go in and do get a piece of paper out and do a weekly at 36.50 and a 40.50 fifth spread. So I would go back to Quickstrike. 40.50's got the 22.62. Yeah, some 6,601. So that looks like a good level. I like that level. And the 36.50. Likewise, it's the end of the um, puts. You have your calls and puts. So at the end of the put wall. So that looked, I did pretty good, right? So the indicator did pretty good. Yep. All right. So I like that. So let's go into our spread. And be aware that these options and the futures contracts have letters. X is November, Z is December. And let's go in and build a spread. So I'll open a new one, go back into my Quickstrike, change this to Spread Builder. Apologize, I'm getting rid of my chest congestion from my flu, but I feel so much better, more like a human. And no more brain fog either. So let me do a new spread. And we want to do a weekly. So we want to do that November 18th. and I want to choose options. And for my pit wall, I'm going to do 3650. So I click that little arrow, find my 3650, change it, invert it to short put, and for my call wall, I want to do 4050. And this is a strangle, right? And a short strangle. That's what I'm doing. So I'm selling a call and I'm selling a put. And what this does is that if price stays inside that range and closes anywhere in there, it doesn't matter what the gamma's doing, the theta, the whatever, the delta. If price stays inside that range by the end of the week and closes, then I get to keep the premium. And the premium is $19.73. And well, you multiply that by 100, and that is $1,973 for the week. So let's put that down, 1,973, and look to see what the margin is. The margin would be 10,790. So if I take my calculator and if I divide the 1973 into the 10,790, I can see that I get an 18% return on the 1 week of my investment of $10,719. So 18% interest for the week is a really damn good thing to do, right? I don't think a bank will give you 18% if you were to park your money there. But you do have to park your money. You have to keep it in your account. All right. We can also trade those daily ones every day. Remember what I told you? We can do the Globex daily on a day by day basis. So if you just sold your whatever is higher or lower of your daily 3 or your Globex 3, you can get extra premium during the day. So right now, that would be 40.70 and 38.66. That would be the widest spread there is, 38.66 and 40.70. So if I were to go back to my Quickstrike and do a new spread and look for that first Monday expiration, I could look for the 40.70, invert it, short call, and 38.66. Let's do 38.65, short put, say OK, and I've got another $460. So 460, and my margin required for that would be 9,737. And if I were to divide the 460 into that 9,737, that would be a 5% return for the week. So I've taken my weekly and the 1 day 2433, 2,433 I'm up to in premium collected, and I would have to put 10,790 and 9,737, $22,960 to work. So if I could set aside $22,960 for the week, I would be able to, at least get that much premium if it stayed inside the options, inside those ranges. So I think selling premium obviously is something that is very attractive to pension funds, investors, 401k managers, banks. The market is 60% with these retirement savings accounts, and using these Black-Scholes models is something that the market adheres to. You can even bring your risk in further if you see that you're in a declining, decelerating mode. Remember what I said on that distribution. If it is a low volatility, you're going to stay inside that first standard deviation. So if you're in a low volatility and the range is declining, sell the ones. If you're in a medium volatility, sell the twos, and if you're in the high volatility, sell the threes. Right now, we're just selling threes and making this much money. You could make more money by, increasing your risk. Um, but as you can see, you can learn to rely on, if you're going to stay in your ones, you stay in your ones. You see what I'm saying? They go from one to one. When they break the one and go out, they're going with that volatility expansion. Expansion. Got an up and down here. Got that high vol off the bottom. There was a coast to coast, a 3 to 3. And you can learn to pick up futures trades by hitting these levels intraday and, doing very well with minimal risk. Market comes in at these levels consistently because they are standard Black-Scholes model levels on real volatility. This isn't the implied volatility. This isn't the selling the 10 delta, or where's my, lost my old pricing sheet. They'll come in and sell a arbitrary 10 delta, or 13 delta, or whatever they're doing. Um, I like knowing what they're doing and then expecting or anticipating those turns. Be ahead of the game. See where their implied volatility level turns are. See if the market turns there, and be prepared to act in the market. And having this indicator just fits in perfectly with this concept. And like you can see clearly, um, clearly, just open your eyes, you can see that this is where the market trades to. Um, Using, statistics. Um, Statistics and standard deviation, and yes, it does work. Now, yes, there are other levels. As you know, you've got VWAP, you've got um, volume profile, you've got other methodology, volume. Um, I don't like volume because you can't rely on it. A lot of the volume is blocked. We don't see it. And the risk for these, banks and market makers do not show up in the DOM until very last minute, or they're hidden. You don't see them until 5 o'clock that day when the block trades are posted after the market closes. So you won't even see it show up on the order flow. I know that you can get some really good volume trades. I'm not saying that it's not a great system. It does work, but you don't see everything. And I know from just empirical observations of knowing, understanding what my bell curves are, and knowing that I can rely on these ones, twos, and threes and anticipate these changes, especially if I get it with a implied volatility level and it matches my overall um, slope, whether I'm going, you know, up or down on the volatility slope. This is the secret sauce right here, because I can tell you um, if the vol is decreasing, you're not going to get to those outer targets. Do you see that? Vol decreasing and it went up at the ones. I mean, I don't know how much I can show you other than just showing you that you're not going to get to these outer targets with falling volatility. It ain't going to happen. So that's why they come in and buy these. And all it is this. Watch this video and you'll understand their algos are already pre-programmed. They're not going to change the market structure. We've just tapped into it, okay? And can see there's a lot of lines, there's a lot of levels, but just getting an overall feeling of whether your range is expanding. Are you going long vol long? Are you going long vol short? Bloodhound will allow us to use solvers to prepare trade strategies by only going long vol short. For instance, if you wanted to put together a trade strategy that would only trade long vol short, you could easily do so. Or if you wanted to trade short and long vol, which is fun, you have wider ranges, but you pretty much know that you can trade to those outer targets, then you can prepare a strategy to do that. And also prepare a strategy and be aware of what these threshold levels are. When you get to the extreme vol, usually that will signal, remember that parameter range? Um, you can see that the market will trade to these statistical levels and then turn around a lot, or signal that you're exceeding, breaking the range, and reaching for those further targets to trade to. If you're going up with the slope or you're decelerating, coming back down. So, how to get the indicator? Let's see. I must have this. Nope. Here we go. Come to the website. Go to PT indicator. Um, this also can be. I have templates for you to put this in the market analyzer, so you can break down the time frames. You'll know how many points to expect in a normal distribution in Globex. Your daily range, London session, Asia session, you can set it up per your market. RTH session, 1 hour IB, 30-minute opening range, the first 30 minutes traded, or 15 minutes or 5 minutes. How many points to expect the market to trade to in these volatility thresholds. So if you have low vol, medium vol, high vol, you can get an idea of a target that is obtainable. I don't trade the threes all the time, that would be sort of silly. Um, Learn to trade to your ones and twos, take your money and run. You don't make any money unless you keep it. You don't make any money trading to top tick or the last target. You make money by being able to consistently go into the market, know whether you're going long or short, and knowing where to take your profits or trade to, and then going home for the day. And I like the concept of trading the option, selling the premium. So between selling the premium, oops, what did I hit? Sorry, hang on. Selling the premium, collecting that on a weekly, monthly, quarterly, bi-weekly, bi-month, every 2 weeks, 45 days, 50 days, whatever, distribution you would like, you can create a distribution in using the indicator. So if you just want to look at monthlies, or if you want to make a new distribution for 50 days or whatever, you can draw a bell curve and know your levels to trade, to the premium to trade to. And as you can see, these markets, may go down to challenge your area, but it's like hitting that brick wall, right? Um, they rarely break. Um, when they do break, it is a hedging condition, and you need to have a plan to address that. But 95% of the time, or 99% of the time, you're not going to have to worry about that. You can just keep your premium. So you keep the premium. I mean, look at this one. It even went down to the bottom of that little hook thing and stopped cold because they know where these levels are. Um, so anyway, that is the path. We have training on Wednesdays, and come join us. Get the indicator, J-Auto trading strategies, and join us. Love to have you. All right. Thank you so much. I hope this makes sense to you. And I will talk to you soon.